Hello, I'm Alex Mozed, and welcome to Winner Take All, where we talk about the constant battle to fight back and win against big tech. I'm really pleased to have two guests today. We've got Nick Johnson, co-author with me on the book Modern Monopolies, and we have Kara Marciscano, analyst at WisdomTree. Great to have you both on the show. Nick.
Thanks for having me, Alex.
Kara, great to have you. So, what we want to talk about today is the WisdomTree Growth Leaders Fund was recently rebalanced, and what that means is that every year these indices get rebalanced by basically updating what is the composition of the index, what stocks are in it, what stocks are out of it. Weightings get adjusted and all that good stuff. So we thought it'd be a great time. It's kind of like an annual refresh, basically, to have both Nick and Kara join us. And I think one of the interesting things, Kara, you were talking about was the number of recently IPO'd tech companies that joined the index this year. What can you tell us about that, Kara?
Yeah, that's right. So we just completed, the annual rebalance, which, just to reiterate, it means Applico refreshed their analysis of the investable universe for platform companies, and that's a key input for our fund, the WisdomTree Growth Leaders Fund, ticker PLAT. And one of the key insights we have from this annual refresh is this was the biggest rebalance in terms of IPO additions to the fund since it launched in 2019. So we had 24 additions in total. 14 of those were companies that had IPO'd in the last 12 months. And this is a very, very high growth rate, 14 bunch of companies. Their average growth rate over the trailing 12 months is 64%. And some of those names are going to be, names that most people are familiar with, like online food ordering companies, Deliveroo, DoorDash. The I would say mega IPO of 2020, Snowflake, the cloud computing company, gaming platform, Roblox. We have Bumble, the dating platform, Airbnb, rental marketplace. So it's a really diverse set of new additions as well, which I think speaks to also the sector diversity, which you can maybe hit on a little bit later. I don't know, Nick, if you had any comments on some of these new additions.
Yeah, I think we've got some really cool ones. I think another one I would add to that mix is ACV Auctions. They are in the auto sector, essentially, selling cars, salvage cars in a lot of cases from dealers and salvage yards to other dealers, and insurance companies selling off cars. It's a very cool business, and one the car marketplace space is crowded, but that B2B sector of it is actually quite profitable, and they're a company that has really been challenging some of the incumbents that have been in that space for decades, and doing quite well. So I think ACV Auctions is definitely one to watch. I think another one that I think is a big one to watch, Roblox. I think they had a challenging quarter recently, but have been kind of doing very well overall. I think that's a little bit to be expected as people aren't cooped up as much anymore as they have been for the last 18 months. Gaming revenue in general will slow down a little bit, but I think their I would say long-term outlook is I would say quite promising. It's a very cool company. If you've got any kids under the age of 15, I guarantee you they probably have played Roblox. Other ones that are big, of course, most people will know Airbnb and DoorDash. They're really have been kind of staple platform companies for a while now. DoorDash is probably up there with Uber Eats as the biggest food delivery company in the U.S. And then Airbnb, kind of in a class unto itself for home hosting, alternative stays to hotels. It took a while to go public there, but it finally is, and we're very excited to be able to include it.
Awesome. Yeah, I think to your point, like PLAT has some hidden gems in there, like ACV in the industrial sector. It's a cross-sector growth fund. I think when a lot of investors think growth, they probably think infotech, but PLAT is different than most of those competing funds. So if you think about the NASDAQ 100 or the Russell 1000 growth, which most investors lean towards, their sector exposure is like 40 to 50% infotech, right? That's arguably, you're making a sector bet. PLAT in contrast is a third infotech, communication services, consumer discretionary, and just like you were talking about, it's got industrials with companies like ACV, it's got some financials, it has some healthcare exposure as well. So you get nice sector diversification with PLAT. And you also, as a plus, get some size diversity as well. NASDAQ and Russell Growth are like 100% large cap. We're about 80-20 large and mid cap companies.
Yeah, and the other plus we were talking about, Kara, is that, I mean, I guess this was kind of a little just luck that the rebalance came at this time of year. I mean, because we've been talking about on the show how, months ago when we were kind of in the height of SPAC mania, that at least from my opinion, these valuations just seemed extremely frothy, to put it nicely. But you actually look, I mean, these are very strong companies, but even Airbnb was over $200 a share. Now it's at $150. DoorDash, same thing, over $200 a share. Roblox is still up. What else was kind of egregiously high? Oh, Poshmark. We did a whole segment on Poshmark when it was at $100 a share. Yeah, is it at? Let's see. Poshmark IPO'd. It's hilarious, at $101 a share, which made absolutely no sense. But hey, now at roughly $50 a share, it makes a lot more sense. Now the index doesn't control, it's not actively managed. So you're not buying and selling and kind of optimizing, exactly these kinds of price differentials. But I think it was just kind of fortuitous that the rebalance happened now rather than, 5 months ago, basically.
Yeah, absolutely. And I mean, the fund itself is at a more attractive valuation than it was 6 months ago. At its peak, it was like 9 to 10 times on trailing price to sales. Today, it's closer to 8.5. So a turn-ish lower, definitely more attractive. I think one of the nice things about the rebalance, it does have a market cap weighting component to it, but the valuation was more or less kept constant, which is nice because what we saw was keeping valuations constant, definitely lower than 6 months ago, but a big increase in the growth rate of the fund. So you're getting more growth at the same price. And one interesting fact about PLAT is if you were to cut the S&P 500 right into deciles, rank those companies by revenue growth, and take the top 50 growers within the S&P 500, those 50 companies are growing at a rate of 42%. PLAT, on average, the entire basket, around that same rate. So you're really getting top tier growth rates with PLAT. And also, if we were to look further back, that growth rate is a little bit more consistent, or a lot more consistent than what you would get with a 3-year look back of the S&P 500 or the NASDAQ. So the 3-year average growth rate of PLAT is 30%. That's double the S&P 500, which is around 15, and 10 percentage points higher than the NASDAQ 100 index. So what we've done is a nice valuation reset, kept it constant, increased the growth rate, kept quality fundamentals like margins consistent. And then what's really, really nice about these companies is they don't hold heavy weights in depreciating assets like inventory or property, plant, and equipment. Their biggest asset on their balance sheet continues to be, an intangible, which is their network and cash. So having your largest percentage of assets being cash, I think, is a very important factor for businesses today. So we're really happy with how the rebalance turned out. These are very attractive fundamentals and a solid valuation.
Definitely, there's I say benefits to the platform business model, which is where the PLAT ticker comes from, and being asset light and having those network effects where you've got these third parties providing all the inventory or value is one of the big benefits there.
Absolutely.
And the other interesting thing, if I look at this sector breakdown that you were talking about, Kara, I mean, Nick, this is new, right? I mean, it's still small, but we did see, for example, healthcare go up a little bit. There was some new healthcare additions, right? What were we seeing in that area where I think it was just Teladoc, right? Prior to this rebalance.
Yeah, we've got in there JD Health International, which is JD, the kind of Amazon-esque of China. They have this spun out basically a JD Health arm, which is healthcare, telehealth. American Well, another kind of telehealth focused company, and then GoodRx Holdings, which is kind of a marketplace for getting good prices on generic and prescription drugs, primarily for people who don't have insurance. They've got a bunch of different pharmacies, and they help you get good prices, basically, and it's a marketplace for that. So I think it's a very cool company. And we're definitely, unsurprisingly, I think, given the pandemic, seen an uptick in healthcare companies, and I would expect we're probably going to see another few going public over the next couple of years.
That makes sense. And one company I thought was really cool, which at first blush you kind of look at it and you say, yeah, this is a SaaS company. And that company, you may know the one I'm talking about, is Snowflake. But the team obviously went a lot deeper to really try to understand this business in more depth. And so it isn't really just a SaaS company. It actually has legitimate platform dynamics. How did that play out, Nick? What were some of those kind of platform dynamics that came to light for Snowflake?
Yeah, Snowflake is a very cool company. They have what they call basically a data cloud, and that's kind of the core application. And then they have basically a data exchange marketplace. And that's really where a lot of the network effects come in for them, in addition to kind of the internal getting more people on board generates some network effects as it grows with each user. So I think it's a very cool company, one of the first, I think, that we see in the index that really has that kind of data exchange dynamic. You see a lot of, I would say, earlier stage companies in healthcare, for example, that are doing these kinds of things. And that is an area where Snowflake, of course, has a concentration of customers. So I think we may see more companies like this ahead, but for now, Snowflake really kind of stands out as somewhat unique in the basket.
Love that. What else, Kara? What are some other interesting insights that maybe come to light that we haven't touched on?
I think one question that we get a lot is like, what makes a platform company a platform? And I do think we get a lot of questions from clients about, is every SaaS or software as a service company eligible for PLAT? So I'd love to get your thoughts on, why is every company, SaaS company, not a eligible platform business?
Yeah, I think that's a great question. I think the confusion is that a lot of SaaS companies call their product suite a platform. We would view that as more a platform as a marketing term as opposed to what we're focused on, which is platform as a business model. So what are the things that we're looking for? One, they've got to have multiple user groups that they're interacting. Typically, we would call it a consumer and a producer. Producer is the person that creates the value. One of the criteria is that the primary value that the platform is delivering has to come from the producer. So it's not sitting on your balance sheet. It's not just the software you create yourself, which is what a SaaS company does. That producer is creating some external value. So that could be content, that could be other types of software that plug in, that could be data, as in the case of Snowflake, where they have this data marketplace. But the value can't all be being created by essentially the company itself. Which is why a lot of SaaS companies don't qualify, because they're really just creating a suite of software tools rather than, say, opening up an app marketplace around that, which is, for example, what a Salesforce has done. They've got a very big development platform, third-party app store. Salesforce's core application is a SaaS application, wouldn't qualify on its own, but they've built this multi-billion-dollar app store business around Salesforce. So that's an example of a SaaS company that does qualify. But a lot of SaaS companies, they might have an app marketplace, but it's not a meaningful driver of revenue. So there are revenue thresholds here. They've got to meet a certain amount of platform-based revenue in order to qualify. And if they don't hit those thresholds, then it's because they're not enough of a platform business where we would really view that as a material driver of the business's success. It's more of a traditional SaaS or linear business. So the way I would think about it simply is, does it have this network of third parties creating value rather than it creating all the value itself? How big is that network? Is it a real material driver of revenue? You've got some companies like a Shopify, for example, that have kind of baby app stores, but it's not a material driver of revenue for them. So we wouldn't view it as a main factor, and doesn't make them a platform business.
Yeah, and I think what I gather from that is it's not just screening 10Ks for the word platform. Applico's doing in-depth analysis, making sure that these companies are actually platform businesses. There are many rules and regulations that go into the research behind the data set that PLAT's using. It's not just a web scrape, right? It's finding these pure play platform businesses. And I think that's so important, especially, when you're offering a fund and we have an expert partner. I don't know of any other funds out there that have that same sort of detailed analysis into financial filings of these companies.
Yeah, I think as you can see behind Alex on his screen there, we at Apical, we kind of wrote the book on platforms and really have taken that definition of platform and put together pretty robust, I would say extremely robust criteria for what qualifies as a platform business. And there's a lot of analysis that goes into that. As you said, it's not just screening for the word platform, because we know there are a lot of companies out there that say, oh, we're a platform, but it's really just this, as a marketing term, they mean we have a bunch of stuff and we put it in one package. So we have I think it's 8 or 9 part criteria that we go through in depth and really look for. Do they have this platform dynamic? Do they actually own the network? Is there network effects happening here? And then how big of a percentage of their business is that? Is this a material part of the business, or is this just kind of an add-on that's not really driving the dynamics of the business? And that's really what boils down to: is this a platform business or not, and should we include it in our data set?
Right.
Well, and these companies are smart, and by these companies, I mean not platform business companies. So when you read through the 10K, to your point, Kara, they're using the platform word, right? Everyone wants to have this kind of platform aura around their stock, and to have investors think, oh yeah, this is a platform. Everyone's kind of started to want some of that platform juju. So there's a lot of companies that you look at and you say, oh, they, for example, that's the other thing. There might be companies that actually do have legitimate platform network effects, but it actually isn't a meaningful enough part of the business that it gets included in the index. Like, one that comes to mind for me is Affirm, where Affirm is a Max Levchin company, ex PayPal. Guy understands platform businesses really well. And they do talk a lot about a variety of network effects that they have, really their core business is a B2B2C, kind of like digitally enabled lending pipe, right? The legitimate part of the platform business that they have is they do, if you are in a firm borrower, consumer essentially, they do have, I think, like a little marketplace of all of their merchants that you can shop from and kind of browse, kind of like what Shopify does with Shop. Shopify is probably another good example we could talk about. But, they do have like a little kind of product marketplace that they talk about in the 10K or their S1 or both. But it's such a minuscule part of their overall business that not only are we looking at, do they have the right platform dynamics, but do they actually have enough platform revenue that this is a material part of the business? Another one is Walmart that's not in the index. They do have Walmart Marketplace. We're actually very bullish on Walmart's ability to embrace a marketplace business model. But given the scale of Walmart's linear business, which is hundreds and hundreds of billions of dollars in what we would call kind of linear, traditional store retailing sales, and then they have 1P on their e-commerce, how big is that 3P part of the marketplace? They don't really break that out for us, but you can also tell that relative to the rest of the core business, it still has a ways to go until it hits certain thresholds, which have been objectively defined as it relates to different platform types. So product marketplaces need to have a certain level of platform revenue threshold relative to their linear revenue. The other example is Shopify, which also has a shop app, which is a legitimate marketplace part of their business. And now they're getting into payments. Their Shopify payment platform has now just been adopted by, I think Google and maybe Amazon, one other big company, maybe Facebook and Google. But I think that's another example where, a lot of their business is really a SaaS business, enabling small businesses to do e-commerce better. Nick, any other color you would add to that?
Yeah, I think you kind of hit the nail on the head. What we're looking for here is businesses that really have this platform dynamic, and it's a meaningful driver of their business. Why is that important? It's because these platforms, as you can see in the name of the show, tend to be winner take all. So we're really looking for the ones that have this kind of dominant network effect that's driving the business, because we think those are going to be the highest growth companies, the most profitable long term. And that's really what's going to drive the success of this basket. It's really, we believe this is kind of the business model of the future. We've certainly seen that play out over the last 5 years, but it's continuing to take over more and more sectors, healthcare, all parts of the industrial economy. We've also recently did a ranking of the top 50 B2B marketplaces, which are, some of them are growing quite large. And I would expect in the next 5 years, we're going to see some of them in the index as those eventually start to go public. So it's a business model that is really kind of dominant and here to stay. And this is really a bet on the growth and the profitability that business model offers.
Other thing is, a company that actually, they don't really try to even tout themselves as a platform. Actually, I don't think we see it as much in their 10K the word platform as Netflix. And we've long been, kind of raising the alarm that Netflix doesn't have a winner-take-all dynamic. They don't have the defensibility that a YouTube has. We penned this article, which is on WisdomTree's blog, saying FANG is now FAMGA, and basically removing Netflix and replacing that with Microsoft, a much better representative example of a platform that is legitimately a tech monopoly and has very, very strong winner-take-all dynamics. And ultimately, I think that's kind of played out correctly in favor of the index and PLAT. I haven't looked at Netflix's stock here in a bit, but yeah, I mean, here you go. It's flat, it's up, it's down, but it's not really doing much. This is it's been this way for the past year or so, which makes sense when you think that these stocks are so heavily fueled on growth. And if you can't continue to show the growth, then you lose favor, and you can't really justify the same type of PE ratios, which you can when you have really strong and continued growth. So, yeah, I think that's a great point, Kara, on the objectivity and the level of specificity that you really have to go into to kind of make the call: is this a platform business or not?
Right.
The other thing that I love is this little chart, which shows the past year. If we're looking at Netflix over the past year, let's look at the index over the past year and compare it to the NASDAQ 100 and the S&P and some other benchmark indices, looking at the past year in review. And of course, as you would expect, the WisdomTree Growth Leaders Index is the white line, way ahead of the pack. What do you make of this, Kara?
I mean, I think especially over the last year, you think we had a pandemic. If you have businesses that are not investing heavily in property, plant, and equipment, that aren't getting used, that aren't sitting on inventory and people aren't going into stores, I think that shows over the last trailing 12 months. The index beating the NASDAQ 100 by 5 percentage points, the Russell 1000 growth by 10 percentage points. It makes sense. These are, the businesses of the future, as Nick said. So one thing I think is really interesting is what we're starting to see play out, and which will be probably a hot topic for many rebalances to come. What is going on the private side? What's the pipeline of companies that could potentially become eligible over, the next year when we rebalance next May, whether they're entering through SPACs or through the traditional IPO process, or, what regular businesses or traditional businesses out there today are making strategic acquisitions to increase the revenue profile of their business to include the things that, our index and our fund really screen for. I think we're going to see more and more of those companies become public or transpire from acquisitions, mergers. It's a really, really interesting space to be in, and this fund is perfectly positioned to take advantage of how that plays out.
Yeah, I think we've got a great slate of IPOs that I think are likely this year. Discord is a great one. It's a sort of chat app or chat platform for gaming. Let's see what else. Didi, the Chinese Uber, basically, though, that has filed for an IPO, and that's going to be a big one. Instacart is another one that a lot of people have gotten familiar with over the last 12 months here. So that there are definitely some big names that are likely to go public in the next 12 months that might make it into the next rebalance coming up here.
Yep, it's exciting.
Yeah, and maybe a little bit to your point, Kara, Discord is an example. Microsoft tried to buy them, and Discord turned them down. And I think seems like they're opting to say, no, we don't want to get acquired by you, Microsoft. You can wait. We're going to go public. Then let us know if you're still interested after we kind of let the public markets value us. Which I'm sure some of them are thinking that the public markets probably value them higher than whatever Microsoft was offering them, so they'll take their chances and see where investors put them at, and then see what Microsoft does. Which is another topic. We did see some interesting acquisitions of companies in the index this past year, namely Salesforce buying Slack. That strategically, that move actually made a lot of sense, I think, to me, with Salesforce doing that. We are seeing, from a regulatory standpoint, certainly much more scrutiny on the tech monopolies, the FAMGAs of the world, and how they can use M&A to either eliminate competition or expand into adjacent verticals. We've been talking about that on the show. But I actually don't think Salesforce falls into the monopoly bucket. And so maybe, maybe that's a trend you see more of, where you kind of have these second tier. It's funny, yeah, it's Salesforce second tier. I mean, like a step below tech monopoly status that FAMGA is in, then saying, well, FAMGA can't buy these companies. Maybe Microsoft will be in a more difficult position to be able to buy Discord. But, you're seeing a lot of growth from these companies that are either, I don't know what would you call them, like Slack size, that $30 to $50 billion size, and then Salesforce, which was in the low hundreds of billions of size. It's interesting. You're kind of seeing some tiers here in kind of stages, and I think then you're starting to see M&A possibilities from slightly larger platforms looking to buy slightly smaller platforms and expand into adjacent markets, and that being now kind of restricted for the largest tier that is tech monopoly. I don't know how you translate that into financial analyst talk, Kara, but at least that's some of what I see from my perch. I don't know if any of that makes sense or how you think about that.
I think, when we start to see platforms consolidate from two into one, merge, and both are in the index, it's generally, and not always, but it's generally done at premium valuations, right? So if you have someone in the index being taken out at a premium, it's generally a good thing, or even better if someone in the index is taken out by, let's say, and this is not a forecast by any means, but hypothetically, like Walmart buys a platform business in the index, and it does so at a premium valuation. That's a positive catalyst for the performance of the index. Typically, that's what you could expect. So consolidation is generally a good thing, at least from a valuation standpoint or a performance standpoint. I mean, obviously, it always raises questions about regulation, and then there's headline risk, and will the deal go through? But it's interesting, and it's generally, I think, good for the index.
I think the Walmart example is an interesting one, because they're, of course, a great example of a company trying to become a platform business with their marketplace growing very quickly over the last few years. But I think we're starting to see as well more and more large traditional companies embrace this platform model, and M&A is certainly going to be a part of that. So I think that that's something to watch out for in the next couple of years, is do we see more potential big acquisitions of potentially some of the companies in the index, or ones that are in the IPO pipeline that, rather than going public, get bought? And then does that bring a new company that, say not new company, but one that isn't into the basket because they bought a platform business, are now integrating that into their traditional company. So I think that's definitely a trend that we might see in the years ahead.
Sure.
Okay, last topic. In the past few weeks, we've had actually a flurry of tech monopoly or attempts to rein in the power and the inappropriate kind of power vacuum that these tech monopolies have been able to capture. We've seen 5 bills coming out of Andrew Ciciline's subcommittee on antitrust. We've seen Lena Khan actually confirmed as the head of the FTC. And meanwhile, here's Amazon stock up 8% over the past month. So investors don't seem that concerned. Maybe they've just kind of seen this script so many times before. Oh, we're going to rein in big tech, and just don't seem too bothered by it, irrespective of whether that may actually be the case. But at least, I think what's interesting from this is these advancements, I think, are really positive steps in the battle to rein in big tech, which is a valiant and appropriate battle. But at least maybe what the public markets are saying is you're still far away from actually anything material happening that could be a real adverse event or situation for these tech monopolies, before any sort of legislation is passed, before, the FTC really digs in their heels or does something from a regulatory standpoint. Doesn't mean that it won't happen, but I think certainly, at least if if you don't want to read too much into it, but at least some of what this is saying to me, which I think is accurate, is I don't think anything in the immediate to short term is coming, at least from these recent events. How do you see it, Nick?
Yeah, I think I'd say the nice thing about the basket of companies here is I would agree with you. I think it'll certainly be a while before any real impacts are felt. These cases often take years, if not longer. Historically, I think so. It will be a while before any impacts felt. And I think number two would be if there are impacts. They're in the index certainly, but they're in the basket of companies in the data set. But they're one of, or a few out of 60 companies. So it's not. I wouldn't view it as a huge risk to the platform business model in general. I think these are a handful of companies. I think they're very important ones, but there's still going to be a huge amount of growth coming out of all the other companies in the index that aren't facing these kind of regulatory crosswinds. They might one day if they achieve that kind of big status, but they're not there yet, and there's still a lot of growth to be had. So I think that risk is somewhat mitigated in terms of the basket that we have here, and I think that's the nice thing about the basket of companies in the data set is not just a bet on the 5 names you're familiar with. It's really about this business model and the growth that it's bringing in a lot of sectors that you might not think of off the top of your head.
Absolutely.
Yeah, I love that. I've got up here, the top 10 are no more than 52% of the full weighting within the index. So I'd say that's actually pretty well diversified in the grand scheme of things, considering especially how dominant those top 5 are more broadly, within the economy and society, et cetera. What were you going to say, Kara?
No, I was just going to agree with Nick. I think for this, I guess, strategy where you're targeting platforms, it's the ETF solution where it's a basket of companies and you're not necessarily selecting 5 names, but 60. Exactly that point. If one of these regulatory cases actually starts to have some legs, the benefit is there are 59 or whatever, call it the big 5 are targeted. There's 55 others in the basket that are unimpacted, and a lot of hidden gems in there that most investors probably aren't aware of. Like we were talking about, highlighting some of those industrials names before. People aren't necessarily watching those. Some of these new B2B marketplaces, they're not looking at those as regulatory threats, and they're in the basket. So that diversified basket of companies is the way, I think, to invest in this space.
Wonderful. Well, any last thoughts? Anything we didn't touch on?
I think we covered it. Thank you so much for having me.
Kara, so wonderful to have you as always. Nick, great to have you back on. We got to get you on more often here. And thank you both so much. And I think this has been a great update. That's it for us today on Winner Take All. We will talk to you later.
Talk soon.
Thanks, Alex.